Hey everyone, welcome to the channel. Q4 FY26 earnings season. Mixed results for most of the Nifty 50. Global headwinds, commodity costs up, oil prices volatile, supply chain stress still biting some sectors. And yet, five large cap companies cut through all of that noise and delivered profit growth ranging from 23% to 103% year on year. Yes, you heard that right. 103% PAT growth in a quarter where the benchmark index was flat. Now, we are going to go through them one by one, starting from number 5. Each one gets the full treatment. Q4 result breakdown, QoQ performance, earnings call highlights, management guidance, and valuation. By the time we reach stock number 1, trust me, you'll understand exactly why that number is 103%. Quick note before we begin. This is educational content, not investment advice. All data is from NSE/BSE filings and analyst reports. Always consult a SEBI registered advisor before making investment decisions. Alright, let's start the countdown. Stock number 5. This company is India's largest non-banking financial company. It has over 10 crore customers. Its loan book crossed a landmark number this quarter. It lends for everything: your EMI for a washing machine, your home loan, your car, your business. PAT growth 23% year on year. And QoQ up 36.6% on a consolidated basis, one of the sharpest sequential jumps of the quarter. Have you guessed it? It's Bajaj Finance. Q4 FY26 result breakdown. Let's go through the numbers. Consolidated PAT for Q4 FY26, 5,553 crore rupees, up 22% year on year compared to 4,546 crore rupees in Q4 FY25. Now on a sequential basis, the quarter on quarter jump, PAT went from 4,066 crore rupees in Q3 FY26 to 5,553 crore rupees in Q4. That's a 36.6% QoQ surge. Why such a big sequential jump? Q4 is seasonally the strongest quarter for NBFCs. Year-end spending, business disbursements, consumer loans all peak together. Standalone PAT 4,839 crore rupees, up 22.8% year on Y. Net interest income grew 20% year on Y to 11,781 crore rupees. AUM, assets under management, crossed 5 lakh crore rupees. Let that sink in, 5 lakh crore, up 22% year on year. New loans booked in Q4, 1.28 crore loans, up 20% year on Y. NIM, net interest margin, at 10 to 10.5%, highest in the entire NBFC sector. Asset quality, gross NPA at 1.01%, net NPA at 0.41%, both under control. Dividend, 6 rupees per share declared for FY26. QoQ snapshot. Q3 FY26 standalone PAT, 4,066 crore rupees. Q4 FY26 consolidated PAT, 5,553 crore rupees. Sequential growth, plus 36.6%, driven by seasonal credit pickup and improving asset quality. Earnings call highlights. The AUM crossing 5 lakh crore rupees was the headline moment on the call. That's an extraordinary milestone for any non-bank lender. Management highlighted that the customer franchise now exceeds 106 million, over 10 crore customers. And the digital and AI-led acquisition engine is adding customers at a pace that keeps lowering acquisition costs. Morgan Stanley maintained an overweight rating, calling the earnings quality and asset quality improvement confidence-inspiring. One important development, Rajiv Bajaj announced he will not seek re-election as non-executive director at the upcoming AGM. A governance flag worth watching. On regulation, RBI is tightening NBFC rules. Management acknowledged the environment but expressed confidence in their diversified book. Forward guidance: AUM growth 22 to 24% year on Y. PAT Sagar approximately 20% over FY26 to FY29. Key watch for FY27. RBI rate cuts will reprice the floating rate loan book downward. NIM may compress temporarily before funding cost relief flows through. New growth categories: MSME, gold loans, and housing loans, diversifying away from pure consumer credit. Valuation: CMP around 910 rupees on 15th May post split. Market cap approximately 5.67 lakh crore rupees. Trailing PE 29.5 against 5-year median PE of 35. PEG ratio 1.59. Price to book approximately 6.5 times. Analyst consensus price target 9,200 to 10,000 rupees on a pre-split basis, equivalent to approximately 1,040 to 1,120 rupees post-split. Morgan Stanley overweight at 1,120 rupees. MOFSL, Yes Securities, JM Financial, all buy. The stock has delivered 72% returns over 5 years, a genuine compounding machine. The NIM compression risk from rate cuts is the short-term overhang. Long-term thesis, intact. Stock number 4. This company's products are in almost every Indian kitchen. If I say Maggi, you know it. If I say Kit Kat, you know it. If I say Nescafe, well, you probably drank some this morning. PAT growth 27% year on year and Q2Q up 9.4%. But the real story is margins. EBITDA margins jumped 547 basis points quarter on quarter, from 21.3% to 26.3%. That is extraordinary. Nestlé India, NSE Nestlé Ind, FMCG, Food and Beverages. It's Nestlé India. Q4 FY26 Result Breakdown. Revenue 6,748 crore rupees, up 22.6% year on year. The highest ever quarterly domestic revenue in Nestlé India's history. Beat analyst estimates. Street was expecting 6,230 to 6,370 crore rupees. The actual number smashed right through that. Consolidated PAT 1,111 crore rupees, up 27% YoY. Standalone PAT slightly higher at 1,114 crore rupees, up approximately 26%. Beat estimates by roughly 11%. Street expected approximately 998 crore rupees. EBITDA 1,772 crore rupees, up 27.6% year on year. Margin at 26.3%, expanding 87 basis points year on year and a remarkable 547 basis points quarter over quarter. That sequential jump is what made analysts sit up. And here's what made this quarter truly special. All of this happened while advertising and promotional spend jumped by more than 50%. They spent more on marketing and expanded margins. That's pricing power. That's brand strength. Very few companies can pull that off. Dividend 5 rupees per share for FY26, plus 7 rupees interim paid earlier. Total FY26 dividend 12 rupees per share. Stock surged 6.86% on results day to a fresh 52-week high. The market loved it. QoQ snapshot. Q3 FY26 PAT approximately 1,018 crore rupees. EBITDA margin 21.3%. Q4 FY26 PAT 1,114 crore rupees. EBITDA margin 26.3%. Sequential PAT growth plus 9.4% QoQ. Margin expansion plus 547 basis points QoQ. Q4 is seasonally Nestlé's strongest quarter as holiday gifting, KitKat, Munch, winter beverages, Nescafe, and post-festive stocking all converge. But even adjusting for seasonality, this was a beat. Earnings call highlights. CMD Manish Tiwari said the company remained focused on fundamentals and executed with resilience, delivering double-digit, volume-led growth alongside strong market share gains. The key phrase there is volume-led, not price-led, volume. That is the gold standard in FMCG analysis. It means consumers are actually buying more, not just paying more. In an environment where urban consumption has been sluggish for the broader sector, Nestle delivering double-digit volume growth across Maggi, KitKat and Nescafe is exceptional. Commodity tailwinds also helped. Lower global coffee and cocoa prices in Q4 gave cost relief. But management is already signaling that these tailwinds may not persist at the same level in FY27. Return on equity 66.55%. Return on capital employed 92.46%. These are among the highest in the entire Indian market. For context, the FMCG sector average ROE is closer to 25 to 30%. Forward guidance. No explicit revenue guidance. It's Nestlé's global policy not to give formal targets. But the strategic direction is clear. Continue volume-led growth, invest aggressively behind brands, expand into coffee and dairy categories, and push rural distribution harder. With PM Kisan payouts supporting rural consumption and a good Rabi harvest, rural recovery is a structural tailwind for Nestlé over the next 12 to 18 months. Analyst consensus expects 12 to 15% revenue CAGR over FY26 to 28. Valuation. Let's be honest here. CMP around 1,430 rupees on May 15th. Trailing PE 80 to 85 times earnings. This also 5-year median PE. Price to book approximately 60 times. PEG ratio is 6.1. These are expensive numbers. The quality is undeniable. ROE 66%, ROCE 92%, consistent volume growth, zero debt, fortress balance sheet. But for a new investor entering at these levels, the margin of safety is thin. Any earnings miss and the stock will correct sharply. This is a stock for long-term patient investors who want a high-quality compounder in their portfolio and are willing to hold for 5 to 7 years without worrying about short-term PE multiples. Analyst consensus target 2,300 to 2,700 rupees. But note, that's based on various price target methodologies and time horizons. Approach with that context. Stock number 3. This is the world's largest manufacturer of motorcycles and scooters. 25 consecutive years of industry leadership. This fiscal year was their best ever on revenue and profit both. But there's a controversy. Their domestic market share has slipped to a 25-year low, and that has the analyst community sharply divided. PAT growth 30% year-on-year. Q-on-Q up 3.9%, modest sequential growth reflecting a strong Q3 festive base. It's Hero MotoCorp. Q4 FY26 Result breakdown. Consolidated revenue 12,797 crore rupees, up 29% Y-on-Y. This beat analyst estimates. Consensus was 9,800 to 10,200 crore rupees on older estimates, and actual came in well above. Consolidated PAT 1,401 crore rupees, up 30% Y-on-Y. Highest ever Q4 PAT. Full year FY26 revenue 46,830 crore rupees, up 15% Y-on-Y, and PAT 5,268 crore rupees, up 14% Y-on-Y. Both all-time highs. EBITDA margin for the full year 14.7%, up 30 basis points Y-on-Y. Margin recovery is happening, but slowly. FY26 volumes 64.69 lakh units, up 10% Y on Y. VIDA EV recorded 190% growth in FY26. Global business grew 40% Y on Y. Company now present in 52 countries, including new entries into Europe and the UK. Dividend 185 rupees per share total for FY26. 110 rupees interim plus 75 rupees final. That's a 3.5 to 4% dividend yield at current prices. Q on Q snapshot. Q3 FY26 PAT 1348 crore rupees, normalized 1439 crore rupees. Q3 had 119 crore rupees exceptional provision for labor code. Q4 FY26 PAT 1401 crore rupees. Sequential PAT growth plus 3.9%. Q on Q modest growth as Q3 was an exceptionally strong festive quarter with record volume of 16.97 lakh units. Earnings call highlights. New CEO Harshavardhan Chitale led the call with 5 strategic focus areas: scooters, premium motorcycles, global markets, EVs, and the parts and accessories business. The ICE scooter segment, Extreme and Glamour, posted 24% growth in Q4. Strong. The Harley-Davidson business, which Hero manages for the Indian market, grew 26% in dispatch volumes with new product launches. Global expansion into Colombia saw market share jump from 5% to 9%. Bangladesh remains a stronghold. Hero made a strategic bet: 210 crore rupees invested in Euler Motors, a commercial EV company, taking their stake to 36.67%. This is their play on the commercial EV transition beyond just personal two-wheelers. The elephant in the room. Domestic market share around 28%, a 25-year low. Management acknowledged this directly and pointed to product launches and premium segment push as the solution. Forward guidance. Industry 2 double growth expected. High single digit for FY27. Target. EBITDA margin recovery toward 15 to 17% over the medium term. Currently 14.7%. New products. Charisma and Xpulse in the premium segment. Export relaunch. Colombia and Africa. VIDA EV, scaling up. New model pipeline coming. Long-term backdrop. Jefferies estimates 8% industry CAGR over FY26 to 29. Valuation. And here's where it gets interesting. CMP, around 5,064 rupees on May 15th. Trailing PE, approximately 17.4 times against 5-year median PE of 20.5 times. Market cap, approximately 1.01 lakh crore rupees. Compare this. Bajaj Auto trades at 26 to 30 times. TVS Motor at over 50 times. Hero MotoCorp is the cheapest large-cap two-wheeler stock in India. And that's exactly why the street is split. Motilal Oswal says buy at 6,248 rupees, 18.3 times FY27 EEPS. They see value. Jefferies upgraded to hold at 5,000 rupees. Healthy demand outlook, approximately 4% dividend yield provides support. Goldman Sachs says sell at 4,300 rupees. They expect margin headwinds and continued market share pressure. At 5,270 rupees, you're caught in the middle of that debate. The cheap valuation and high dividend yield are the bull case. The market share loss and slower premium segment growth are the bear case. Stock number 2. This company holds the number 1 position in SUVs in India. It is also the number one tractor manufacturer in the country. In Q4 FY26, it posted its highest ever quarterly revenue. And yet, on the day results were announced, the stock initially fell 3.5%. PAT growth 42% year on year. But Q on Q, PAT was almost flat, down a marginal 0.15%. The reason is a story about margins under pressure even as the top line roared. It's Mahindra and Mahindra. Q4 FY26 result breakdown. Revenue 54,982 crore rupees, up 29% year over year. The highest ever quarterly revenue in M&M's history. That is the seventh consecutive quarter of sequential revenue growth. Remarkable execution. PAT 5,260 crore rupees, up 48% year on year compared to 3,542 crore rupees in Q4 FY25. SUV volumes in Q4 1.84 lakh units, up 21% year on year. M&M retains the number one SUV position. Tractor billing crossed 5 lakh units in full year FY26, a first ever. M&M became India's fifth largest PV and CV exporter in FY26, a new milestone. Cash generation 16,000 crore rupees in net operating cash flows for FY26. Rock solid balance sheet. Dividend 33 rupees per share, a 30% increase over FY25. But here's the wrinkle. EBITDA margins contracted from 19.6% in Q3 to 17.7% in Q4. That's a 189 basis point sequential drop. Higher employee costs and operational expenses from rapid scaling squeezed margins. And that's why the stock dipped even on a strong result. Earnings call highlights. Group CEO Anish Shah called FY26 a defining year despite geopolitical headwinds. Here's the statement that got analysts' attention. An analyst asked, given the high base of FY26, can M&M sustain its 15 to 20% EPS growth target? CEO Rajesh Jejurikar responded, if I were to look at the next 5 years, we'd be very comfortable saying we will grow 15 to 20% a year. It's also possible all 5 years are higher. That's a powerful long-term commitment from the management. Growth gems. M&M's cluster of new age businesses spanning real estate, logistics, and other ventures delivered 50% PAT growth in FY26. This is increasingly becoming a meaningful part of the story. One concern flagged. Supply chain visibility on DRAMs and gas supplies is only 3 to 4 months. That's a sourcing risk worth monitoring. FII holdings dropped 2.3 percentage points over FY26, but domestic mutual funds added 1.86 percentage points. Forward guidance. SUV growth mid to high teens for FY27. 19 new automotive products in the pipeline. Farm equipment 0 to 2% growth expected, moderating after FY26's record. Revenue CAGR approximately 13% over FY26 to 28, Nuvama estimate. Core earnings CAGR approximately 7%, reflects expected margin normalization. Return on invested capital target approximately 60%. Return on equity approximately 18%. EV ambitions Maintain leadership in EV SUV segment with upcoming electric launches. Valuation. CMP. Around 3,123 rupees on 15th May. Trailing PE. Approximately 24 times against M5-year median PE of 28 times earnings. Here's the peer context. Eicher Motors, 37 times. TVS Motor, 57 times. Within the auto sector, M&M is attractively priced relative to peers. Even Nuvama, which has a buy, acknowledges the valuation is fair, not cheap. Nuvama. Buy at 3,800 rupees, 25 times core FY28 EEPS plus investment value of subsidiary portfolio. Analyst consensus target range 3,500 rupees to 3,800 rupees. The bull case is clear. SUV leadership, EV transition optionality, 5-year EPS CAGR of 15 to 20%. The risk? Margin pressure continuing into FY27 and FII outflows creating headwinds. Before we get to stock number 1, the stock with 103% profit growth, I want to pause for a moment. If you found this analysis useful so far, we've covered 4 stocks, Q4 results analysis, earnings calls, forward guidance, and valuations across NBFCs, FMCG, two-wheelers, and automobiles. Please hit the like button right now. It genuinely helps more investors discover this content. Subscribe if you haven't already. We do this kind of in-depth earnings analysis every quarter. And drop a comment. Do you want us to cover mid-cap stocks, small cap, sector-specific analysis, any stock of your choice? Tell us below and we'll plan the next video around what you want to see. Alright, now stock number 1. The highest profit growth on our list today. It is a 2- and 3-wheeler manufacturer. This quarter, it crossed a milestone of 6 lakh export units for the second consecutive time. Its electric vehicle brand crossed 1 lakh retail in a single quarter. It completed the integration of a famous European motorcycle brand after acquiring a controlling stake last year. And that integration is now showing up dramatically in the consolidated numbers. PAT growth year-on-year, 34% on a standalone basis, 103% on a consolidated basis. Q-on-Q, standalone PAT up 25% quarter-on-quarter. And management declared a 150 rupee dividend per share plus a buyback at 12,000 rupees per share, returning 100% of PAT to shareholders. Have you guessed it? It's Bajaj Auto. Q4 FY26 result breakdown. Standalone revenue 17,832 crore rupees, up 41% year-on-year. Record quarterly revenue in the company's history. Standalone EBITDA 3,075 crore rupees, up 14% year-on-year. Now here's something important I want to flag transparently. The standalone EBITDA margin came in at 17.25% for Q4, which was lower than the full year standalone margin of 20.5%. Why? Because the Q4 numbers now include consolidation adjustments and cost structures from the KTM acquisition. The full year standalone EBITDA margin of 20.5% reflects the core Bajaj Auto business performance. That's the number to benchmark. Standalone PAT 2,746 rupees crore, up 34% year-on-year compared to 2,049 crore rupees in Q4 FY25. And sequentially, up 25% Q-on-Q from 2,196 crore rupees in Q3. That's the standalone story. With the consolidation KTM AG, after Bajaj acquired a controlling stake in November 2025, consolidated PAT reached 3,662 crore rupees for Q4 FY26, compared to 1,802 crore rupees in Q4 FY25. That is the 103% year-on-year jump. verified from the BSE filing. Consolidated FY26 PAT 10,744 crore rupees, up 47% for the full year. Total volumes in Q4 13.71 lakh units, up 24% year on year. Another record quarter. And then, the most shareholder-friendly gesture of this entire earnings season. 150 rupees dividend per share plus a buyback at 12,000 rupees per share worth 5,633 crore rupees. Total payout 100% of PAT. Q on Q snapshot. Q3 FY26 standalone PAT 2,196 crore rupees. Q4 FY26 standalone PAT 2,746 crore rupees. Sequential growth plus 25%. QoQ revenue QoQ 16,218 crore rupees in Q3 to 17,832 crore rupees in Q4, up 10% sequentially. Consolidated PAT QoQ 2,750 crore rupees in Q3 to 3,662 crore rupees in Q4, up 33% QoQ. Every single metric moved upward quarter on quarter. That's not luck, that's execution. Earnings call highlights. Joint MD Rakesh Sharma called FY26 a defining year. Record performance across every business unit. Exports crossed 6 lakh units for the second consecutive quarter, up 25% year on year. At $2.2 billion, it was the highest ever export revenue in dollar terms. Latin America has now delivered 11 consecutive quarters of growth. For Q1 FY27, Bajaj is raising the export target to 2.2 lakh units per month, up from 2 lakh. Chetak EV crossed 1 lakh retail in Q4. The new C25 variant expands into a more accessible price segment. KTM integration underway post the November 2025 acquisition. KTM and Triumph together posted 40% growth in Q4. Duke and Speed 400 are the volume drivers. Forward guidance, EBITDA margin guidance. Maintain approximately 20% plus despite cost pressures. Bajaj Auto Credit is on track to become a meaningful earnings contributor over the next 2 to 3 years. Motilal Oswal estimates revenue CAGR of 15%, EBITDA CAGR of 15%, PAT CAGR of 14% over FY26 to FY28. Valuation CMP around 10,300 rupees. Market cap approximately 2.9 lakh crore rupees. Trailing PE approximately 27 times. 5-year maiden PE is 25 times. FY27 EPE approximately 22 to 24 times. PB approximately 7.4 times. Dividend yield on FY26 dividend approximately 1.5%, much more generous when you factor in the buyback. Analyst targets. Motilal Oswal, neutral at 9,965 rupees. Sees current price as fair value. Most brokerages. Consensus target 10,800 rupees to 11,500 rupees. Disclaimer. This script is for informational and educational purposes only. Nothing in this video constitutes investment advice. All data sourced from NSE/BSE filings, BSE/NSE exchange announcements, and publicly available analyst reports. April to May 2026. Consult a SEBI registered financial advisor before making any investment decisions. Past performance is not indicative of future returns.